Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we will be discussing the Stochastic Oscillator. The Stochastic Oscillator is used in technical analysis and was invented by George Lane in the 1950s. The indicator measures the opening price of a financially traded asset and compares it to the closing price of a predetermined period of time. Because the data uses historical calculations and plots them into a form of two moving averages, the K-line and the D-line, this is considered to be a lagging momentum indicator. The actual mathematical computations for the tool are very complex, and we will not be going into them in this session. The basic and generally widely used settings for the stochastic oscillator will automatically be set by your broker at 5, 3, and 3. More experienced traders will be able to adjust the settings to their preference, however we will be leaving them on the standard settings for the purpose of this demonstration. The stochastic oscillator is widely used by professional traders and will be offered on almost every trading platform. It can simply be dragged straight onto your trading chart and will sit at the bottom as in our example. The basic principle is that the K-line, which is calculated over a slightly longer time period than the D-line, and when both of these lines are above 80%, the overbought line, the currency pair is considered to be overbought. And when the K and D lines are below 20%, the oversold line, the pair is said to be oversold. Traders look for the K and D lines to have been above the 80% line in the overbought area and then dip below the 80% line where the K line has crossed over the D line, at which point they will go short on the currency pair. Conversely, traders look for the K and D lines to have been below the 20% oversold line, and where the K line has crossed above the D line, they use this as a signal to buy the currency pair. One of the biggest traps that new traders fall into is that they take the stochastic signal as gospel and trade it as an indicator by itself. So, is this stochastic indicator a friend or foe? First, we have to remember that all indicators, and especially lagging indicators, are just that. They are indicators. They're an indication that the market, in this example, might be overbought and ready to turn lower, or the market is oversold and it might move higher. Let's drill down a little bit more by going back to our 4-hour chart of the Euro-USD pair. The larger the time frame, the more likely the longer trend will become apparent, and that's where more pips will be realized, and of course, that translates into more money-making opportunities. By drawing a vertical line at position A, we can follow down and see that the stochastic K and D lines both have moved to the 80% overbought area, and that the K line has crossed below the D line. Both lines have moved down to the 80% overbought line. This is represented by the price action which has been falling. Traders who sold the pair on the signal and stayed in the trade would have seen an overlap pip movement in the favor of 390 pips, which is huge. The stochastic was a true friend at this point. However, traders who abandoned the trade as soon as the stochastic became oversold, as per example on the screen now at position B, because the K and D lines in the oversold area under the 20% line and where the K line is crossed above the D line, they would have been extremely disappointed as the market continued to trend lower. While they would have made around 40 pips, they would have lost out on 350. One of the biggest problems we find with new traders is that they will buy a currency pair in a situation like this, where the trade goes immediately against them and falls, hitting them with losses of over 350 pips on this occasion because they have not supported their trade with a stop loss. This is down to poor risk management. In this example, the stochastic indicator would have been a foe. Let's return to our chart at position C. We can see that the stochastic is oversold, and more importantly, it is staying or remaining very close to the oversold 20% line as the market trends lower. And so the lesson here is that if the market is overbought, it does not necessarily mean that it will automatically fall, and which is clear from our example today. If a pair is oversold, it does not necessarily mean that it will turn around and move higher. So remember, indicators are simply an indication of something that might happen and not definitely will happen. Incorporate good risk management and money protection tools such as stop losses in your trading plan. Learn to use price action as a definitive trend setter while incorporating other technical indicators to more reliably establish entry points for your trade. What is most important, which I'm sure you've heard many times, is to let the trend be your friend and never trade against it. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.